Gordon constant growth model, in its name, defines the fact that we need to assume constant growth. So in looking at this problem, we could say that the last dividend, and the way that I'm going to say that is n minus 1. The reason we will say n minus 1 is whatever period, in which case we're dealing today with right now, the last dividend would have been the one previous to now, was $1.38. The Gordon constant growth model is going to ask us to solve for price at any given point in time, and in our case, n is going to be now. So n would be 0, and it's equal to the next dividend that you would expect to receive, which would be not the last one, but the one that will come forward and continue to grow, divided by our opportunity cost of capital minus whatever that growth is constantly estimated as. So the problem also suggests that that growth for us will be 0.0355 going into the future, and that investors would expect a 15% opportunity cost of capital or rate of return for stocks that are similar, so that if we were to try to calculate the price right now of this particular stock, it would be equal to $1.38 times 1 plus the rate of growth. That would give us our next dividend, which would be $1.43. We then finish executing the formula and divide that by the opportunity cost of capital, subtracting off the growth. And for this problem, we would get a current price reasonable estimate of $12.48.